Good morning. Welcome to the Brew. It's Thursday. That means it's Traders Workshop, and that means that Mark and Jason are joining. Today, we're going to take on the new SIBO index called DSPX. It's the Dispersion Index. So this is going to be part one of a two-part series. And we're going to try to break it down a little bit today, and then we'll continue in another episode with someone from SIBO to talk with us. So let's get to the DSPX right now. Bam. Morning. Hi, boys. How are you?
What's going on?
It seems like Thursday's running into Friday already. That's all. I will say this. I slept really well last night and slept really late. I mean, look at this. You can tell, right? It was nuts.
I was about to say you need your Volant hat.
Yeah, I know. That's my paddle ball hat. So it's in, or pickleball, whatever it's called. It's in my bag. How are you guys? Good?
Good. I was going to comment on your shirt. I really like to do the math, but now that I see the Tradier Hub hat, I don't know. You've got a whole outfit going on.
I got a lot going on here. So DSPX. So I watched the what do you call it? The webinar from SIBO, and I think it was who are they doing this with? I forget now. Oh, dog barking.
S&P Dow Jones.
Yes, correct. All right.
This index is super interesting. Like this, I have to say, is one of
We know what you said, Lex.
What?
We know what you said.
Yeah, I muted myself and said a swear word, right?
Still knew what you said.
Yeah. Can you see my mouth moving? Shut the up. Okay. Mark, sorry. Go ahead. I think this is going to be a little confusing. Not our talk, but generally the concept of this might be a little confusing at first. And it will be like the VIX, like people try to break it down and understand it. And people just said, okay, I get what it means, like the stoplight. Just do what you need to do. But we'll see.
It's cool because like most innovation in the option space is just carbon copying a lot of stuff, right? Like it's infrequent that something truly like different comes out. And I actually think this is like a different vector of risk that it measures, which makes it super cool.
Yeah. So are you able, I know you or Jason, able to describe this thing and give us a good definition of what it is? Do you want to give it a shot?
Sure. I can take a swing at this.
Okay. Go ahead, Mark.
So broadly, what dispersion as like a high level concept is the measurement of the difference between how components in an index behave compared to how the index itself behaves.
Mm-hmm.
So to calculate the S&P 500, what do? We weight all the different components by their market cap weighting, we multiply it by the price, and that sums up to create the value of 4,372 that you see on your screen. So that's just arithmetic of component price times their weight.
Mm-hmm.
What the dispersion index measures is the implied volatility of all those components as measured by a VIX-like formula. So the VIX is a measurement of like the implied volatility based on a whole strip of options. So they take not just the at the money vol. So they take the VIX calculation on all those components, sum those all up by their weights, net that against the actual VIX. And so they take components minus VIX, and that is the dispersion measurement.
Okay.
So how much the vol of the components differs from the net of all those components, which is the index.
Right. Okay. That's important. So I thought I read something that it bases at zero. Is that right? What's the base at zero part?
Base at zero because like the components will always be more volatile than their net because there is necessarily some offsetting diversification from them.
Okay, makes sense.
That it's like the only day actually that they mentioned that it could happen was Volmageddon, when like the VIX was artificially like or the structure of products created an artificially high VIX relative to what the components were implying at that point.
I gotcha. Okay, so base is at zero. Okay, and it's on a 30 calendar day average, I think, right? It measures 30 days out.
That's another really important part of this. So it's not necessarily like the realized effect of what dispersion is.
Mhm.
It's a forward-looking measure. So like to the extent that like if you think about like what a VIX future settles to, a VIX future settles on a Wednesday in November, and the settlement price is based on what the VIX is implying then, which is what the 30-day vol of the SPX is at that time. So dispersion is a measurement of what the forward-looking implied difference between components and index is.
Okay, so understood, I think. What is a high DSPX value imply or indicate?
That's a great question, right? So like it's not the same as, and we didn't even plan this. It's not the same as saying like the VIX is high. We're seeing a lot of volatility or like there's a lot of fear in the market.
Right.
So it doesn't totally correlate with the VIX, and like for that reason, it isn't necessarily like a portfolio tool that you could use to hedge against like equities the way you could use the VIX, for example.
Mm-hmm.
All it's saying is that there's going to be more variation among the different components. So like earnings is a perfect example of when that would tend to happen. The DSPX tends to be higher at earnings because components are going to move around more during that time.
Okay, so is it safe to say that a high DSPX value indicates that there's greater volatility in the components, or is it just greater volatility in general? You know what I mean?
Why don't I think I have a screen share if you want to pull that up. It'll show, because like the returns of the index in these two scenarios, these are both from 2021, produced by the SIBO. So the returns during both of these periods are relatively similar. I think we've got like what is it, plus 2 and change percent versus plus 4%. So relatively up markets for the SPX in total. High dispersion on the left is that wide variation in, you have like some super outperformers and some super underperformers.
Okay.
Whereas low dispersion is a much tighter range of the components around the index.
Got it.
A dispersion of the returns that make up that average. How broadly are those components, differing?
Got it. Okay. So I'm just thinking here. When back, in the firm days on the SIBO, when we were, or you were on Amex maybe, but when we were down there, I'm not sure your firm traded like this. We did a little bit. So we had something, we called Connect, and we would have our individual traders trading in these products measure their decisions based on a dispersion, right? And I'm sure that there's a lot of firms that, the market making community today still does that. And typically you would always be, long component volatility, as needed, because you'd get this dispersion versus selling index premium to offset the theta in all your long components, right? Does that make any sense?
Exactly. So like this has long been a prop trade, like trading the dispersion components. And it's interesting because like you say, the obvious trade would be, well, components have high vol and index has low vol. I'll sell all the components and buy the index. Like that seems like almost naively the trade you want to make, that you want to sell high and buy low. But like you say, like selling index vol works because Apple can move 10%. The S&P is not going to move 10%.
Right. Yeah, and that's how people tend to look at it. They would take even, and I don't remember how they measured it, but now this gives you a pretty good thermometer or barometer of what's going on in dispersion, at least 30 days. But you're right. So it would seem like you do the opposite by selling the components, but because of what you just said, you always had an outlier event in a component, right? And if you're long premium gamma, you do well because of a move, you'd always have that position on, right?
Exactly. You're paying for that gamma. That's what you want, that component to really have the outside move.
That's right.
I'll actually asterisk the S&P can't move 10%. I recently looked it up. There are like a dozen times that the S&P has moved 10% in a day. So that definitely can happen too.
Wow, that's a lot. A dozen times? I don't know. Jason, what do you think about this stuff? I mean, can you use this in your area of the world?
I mean, so this only got released like a month ago, or I guess like 3 weeks ago or so.
Not even.
And I do understand that they are trying to release products on this, futures and options eventually, assuming that it gets traction. So honestly, I mean, it's interesting, and I've always kind of found it interesting. One of our, I guess, all of our mutual friend, Matt Amberson with ORATS, you can ring the bell. There you go.
Hold on.
There you go. He always had like a component implied volatility measure in there, which was always higher, and I did find it interesting. I think it would be something. There's a couple things in this dispersion index that kind of gives me pause to using it at all. Number one is that not all the S&P 500 components have enough liquidity to make a full dispersion index, where if you're doing VIX calculations on a bunch of stocks, you're not going to be able to do it on like the back the back third or back half of the SPX index. I'm
not sure exactly what the number is, but I think that's a fantastic point, and I think that's also like an answer to the why now question. Like, you probably couldn't have done any of this 5 years ago. Right. It's only thanks to the market structure that's evolved with weeklies, tighter liquidity, like that actually allows for this calculation in the first place. And even now, like to your point, we can't even do it on the entire list.
I think though that this DSPX, however, it takes it's a changing basket of components all the time. So it's not the entire 500 components that they're measuring. I think it's a small universe. Like, I can't remember the number, but they're picking the more active liquid ones to measure this dispersion. Is that right, Mark? Did you read that somewhere?
Yeah, that's my understanding. And they do sort of like a quarterly rebalance or evaluation of which are going to be used.
Yeah. So you're right. I mean, there could be, these numbers could be muted a little bit because the real dicey components aren't in the measure. So, and they could cause way more dispersion, I would imagine. Or they could at least.
Yeah. Well, there's some other things too. I mean, like, I think that it would be interesting. It's almost like an implied volatility of market breadth. So, I mean, you kind of, kind of, you know what I mean? Like, there would probably be some higher weighting on like the Magnificent Seven stocks right now in the dispersion index. So you could kind of, if you only want to deal with the implied volatility of those, heavily weighted ones, you can, this may be helpful for you, I don't know, like, doing like a pair trade or something. I mean, the obvious trade would be to short DSPX when earnings are.
Yeah.
But again, it's not every SPX component that's going to be in this. So it's really kind of, it's only been around for a month, so I still have to feel my way around it. But I looked up a lot. I watched most of the webinar before I fell asleep, and then I went to.
Was that a cut? Before I fell asleep.
And then but then I watched it, and I kind of, once I got the understanding of what it was, I thought, how would I use this? Would there be like a pair trade, like Mark was saying, between VIX and DSPX? But the problem is DSPX does not have every component that VIX does. So it's not a true pair trade. Then you have, during earnings season, do I short it? Well, again, if, Tesla had bad earnings not long ago or something, it'll have an outweighted effect on DSPX as opposed to VIX. So you kind of, maybe it won't, maybe there'll be something there. So I still kind of I would have to brainstorm some ideas on how to use this. I'm pretty sure, there's a lot of hedge funds out there and prop shops, like Mark said, that use this strategy without this index. So I think the good thing is that this index brings this this concept to smaller traders who can't simultaneously trade 500 stocks.
Right.
But to use it effectively, I don't know. I still have problems using VIX effectively. Rightfully so.
Right. Well, I imagine there's going to be some arb between this product when it's fully traded and VIX as well.
Yeah.
Right. There's going to be some, trade to do there.
Mhm.
I would imagine.
Yeah, I think like I agree very much with Jason that like in terms of the strategies, that's probably mostly going to be the domain of like, prop shops and like, maybe some hedge funds will have that kind of structure on.
Yep.
As far as like a retail investor, I think it's much more like the VIX, right? It's a great barometer for what's going on. It's a barometer for that breadth you're talking about.
Yeah.
And that in and of itself is interesting, right? Like I've seen some correlations between like the historical measures of dispersion and how much like skew costs in relative in individual components, right?
Mm-hmm.
That the higher dispersion tends to be, the more expensive skew in components is compared to SPX. Like
Right.
that sort of makes sense. So like, while I wouldn't necessarily like trade it, like understanding where that level is, if I was timing a roll or, timing a strategy, I think is a helpful market barometer.
Right. Interesting. So I'm just kind of reading on the side here. A high DSPX index value indicates that investors are becoming more fearful and bearish on the stock market. Is it necessarily bearish?
I don't think so, because it's just saying there's going to be a wider range of returns.
But that can be up and down.
Bullish. There could be a super high performer that creates a high dispersion.
That's right. So that's not necessarily true then, right? I don't think. I mean, I'm just trying to think through it. I don't think that means exactly what that indicates, right?
Well, the other thing too is that on stocks like Nvidia or Tesla, especially, they don't follow the normal like SPX hedging format. I mean, most of the time there are collars and goals to hedge a SPX position, an SPX option position. And something like Nvidia and Tesla, there's people, a lot of funds, and we find there's mostly calls being bought on a speculative trade, as opposed to it's a lot more speculation in the options in individual tickers as opposed to the total SPX. So I don't necessarily think it would be bearish or bullish. I think they're trying to. I think that's like an oversimplification of the index.
Yeah,
agreed. Like I wouldn't buy DSPX as a hedge.
Right.
It wouldn't do that for you.
Right.
Like,
yeah. Okay. I'm trying to think how to use this, because I'm trying, and I'm getting into the directional part of it too, bullish versus bearish. It sounds like you're going to be lured into, when you have high DSPX values, that means there's a lot of dispersion or a lot of variance, and like you said earlier in the show here, Mark, you're going to be lured into selling that component premium, which scares the living daylights out of me to do that. I'm going to try every possibility not to do that. Right.
Yeah. I think it probably, like high DSPX, I would say probably to some degree correlates with higher implied vol. Like that it's probably, like you say, going to be lure you into those. Like, I think that's going to mean higher implied vol.
Right. But maybe not. I don't know. This isn't even, they haven't even listed options on this. So it's just a cash index right now that they're just measuring, right? Correct. So it's not tradable yet, I don't think.
And I think there are some technicalities about how that's going to work, because obviously it's going to have to be like cash settled like the VIX. There's no thing to deliver.
And there's no future yet, right? Or is that happening too?
No, that would be first, and then the options on the future probably.
Yeah. Okay. Interesting. Well, what we're going to do is we're going to get, I think Mark, maybe you suggested, we're going to get someone from SIBO on the next part 2 of this, and deep dive it and see where they're thinking. So someone like Rob from SIBO will totally understand this and give us a take on it. That'll be good.
It's a cool product. Like I definitely like I said at the beginning, like I think this is a different innovation in, the options sort of market measurement.
Right. So they're going to call the VIX the fear index. I wonder what they're going to call this. Maybe the opportunity index or something like that. I don't know.
I like Jason's summary of like its breadth. Like it's like a
It's a
breadth
breadth
of
index.
ball. Like
Interesting. Okay. Are they publishing the number? Can I type it into a platform or into a data feed and get a number on this thing, or not really?
they are publishing it on their website. I don't know if it's on like any of the. I've got
It's
it
on Thinkorswim.
Yeah,
it is on Thinkorswim.
Yeah, so
get it.
Both probably publishing it.
Yeah, it's 28.9.
I was gonna say it's 26 and change, but 28. Okay, so it's higher now than when I last looked in SIBO. Okay, interesting. I wonder what the.
Well, we are coming up on earnings.
That's true. I wonder what the average true range is on this product, DSPX. Daily. Gotta figure that out too.
Let's see.
Can you get it?
Yeah, I can get it.
All right. Well, if that's the case, then I'll stick around for the answer.
Yeah, keep talking, and then I'll
it launched on September 26th, around 26.
Yeah.
It's had a low of 25 a couple days later, and then it's had a high of like 29 yesterday, 2 days ago.
Okay. Well, and
it looks like the average true range is at 1.01.
Yeah.
Got it. So again, it makes sense. We're going into the earnings season, so there's got to be, way more dispersion here, which makes this index go higher, I think, right?
Exactly. Earnings definitely is going to be higher. I don't know how to exactly conceptualize what that 27 number is. It's not like 20. It's not like components are 27 vol points higher. Like that's
right.
Not what that's measuring. It's
It's not like an annualized percentage either. It's like a average of the annualized percentages.
Oh, geez. Okay.
Right.
I can see there's going to be a gigantic iron condor coming. I don't know. I just said that because I love selling premium. In the DSPX, an iron condor. That's what I'm doing.
In the options on DSPX.
When they arrive, yes.
Yeah.
So your short variance of variance of variance.
times 4. Say it 4 times, and then that's what I am.
No, your short variance on the variance of variance around variance.
That's 4 times. That's perfect. That's exactly what I'm doing. I'm doing it.
No, I'm not even kidding. I
ring.
think that's what it is.
I think it is. That's right.
Yeah, I know. It's just.
And if I buy a put on the variance of the variance, then what am I? Short what?
You missed way many variances.
Then your long downside variance on the variance around variance.
Around variance. That's 100% right.
I think it's the average variance of variance.
And you don't even have to think about this. It's the proverbial stoplight scenario. Don't do the math. Just know what to do when it turns green, red, or yellow. That's it. Just know what it means. You don't have to understand the machine. Just know what it means.
Just sell premium.
It's like, when you drink it's like when you drink a bottle of wine, you know more about grapes than most people. However, you open it, you like the bottle, you like the taste, you just drink it. It's good for you.
And then you get another one.
Bingo. All right, the variance of the variance of the variance. That was only 3. I'm gonna keep an eye on this. This is interesting. I want to watch how this moves though. So
it's moving less than I would have thought. Maybe, I don't know. I've never traded a strategy around this, so I don't have like a tight handle on what that is. But like, I honestly expected a little more variance in the variance of variance around variance, average variance.
Well, with an average true range of 1, that seems like a little bit. That's a low variance of variance of variance of variance.
Agree.
Right?
Well, I mean, if you think about it, though, with VIX, the average true range is, at like the 2 area. So it's kind of, at least over the last, if you're counting back 14 days, which I guess it's higher than normal, but.
Yeah. It's nevertheless, it's, this is interesting. I agree. Mark, I think you said this earlier. I think this is one of the newly unique products that's been listed relative to understanding the marketplace, at least the macro part of it.
Definitely.
So I think this is definitely interesting, definitely different. So,
yeah.
All right. Good to see you guys as always. We're going to get Rob on. He's He's at some conference somewhere in the world, so we're gonna get him on. Hope maybe
RMC's this week. I think RMC's in Austin this week.
Yeah, that's where he is. So he's there. That's a risk management conference or something. RMC.
Yeah.
And he'd love to talk about this. So we'll get the right from the horse's mouth take on this. So that'll be good.
Yeah.
Maybe next week we can do it.
I have to shout out one.
Shout
my
out.
wife, whose birthday it is today.
Happy birthday, Jill.
Happy birthday, Jill.
I love it.
Yeah,
you guys should come back to Chicago and take me to lunch again.
Oh yeah, that's what we should do for Jill's birthday.
Exactly. Now you're thinking. Perfect. Mark will fly in.
Let me know. I'll come in. Yeah.
Yeah, and then one of our viewers who knows nothing about options but promised me she would sign in, Marvy, who is my physical therapy scheduler.
Oh, okay. Hi, Marvy. Good. Perfect.
I told her I'd shout out for her.
All right. I love it. All right, boys. Good. We're gonna dive deeper next time with Rob. We'll see how it goes. All right.
All right.
You guys have a good one. We'll talk to you
too. Take it easy.
later.
Happy trading.
Happy trading.